Thanks very much, Bill. Thanks to the board management of Tradex, and most importantly, thank you to all of the unit holders for what's been a fabulous and very long partnership for our firm, and always great to see familiar faces here tonight. As I was thinking about our get-together, it's almost always happening during the course of some very entertaining evenings in sports, and we think about two things that are as Canadian as it gets. One is saving for retirement. I think we're all pretty conservative in terms of pinching our pennies, at least the generations that are perhaps represented in this room. And the second thing that's pretty entertaining and truly Canadian is thinking about hockey. And so, coming from Toronto, there's lots to be made fun of. We know that, having lived in Ottawa and other places, I know there's a Canadian pastime of making fun of Toronto, and I enjoy it too. And I have to tell you that coming up on age 50, we're missing the cartoon here. Is it, well, if you take a look at your booklets, I'll tell you, when I was thinking about this evening, I thought it might be fun, and we didn't know how things were going to end with the Maple Leafs, but if you look at your booklets, you'll see that the recent market context that was commenting on the fact that we've had this fabulous rally, and in the last couple of years, the Maple Leafs have tried to rally as well, but unfortunately, the market's done a far better job, and as some of you may know of actor Will Ferrell. I'm sure you've probably seen, perhaps some of you have seen this movie where he was Ron Burgundy. Anyway, he has a joke and he says, want to hear a real hockey joke? And there's a long pause and he says, the Leafs. and then another one of his jokes is, no wonder they wear a blue outfit. Anyway, in terms of the market context itself, thankfully, we'll talk about the last 10 years. Thankfully, the markets have done a much more consistent job of performing for us. Recently, we've been through a fair bit of volatility, as I think everybody can relate to. There was the last 6 months of last year, we had a full move and just touched down into bear market correction territory, so a 20% decline. These indices cover that up a little bit because these are total return indices. So they include the benefit that all of us receive of the compound power of reinvested dividends. And the reason why they're interesting to look at is this is truly the experience that you'll hopefully receive for investing over a long period of time. And so I put them up just to illustrate to you that even the TSX here has managed to get back to all-time highs from a total return perspective. And when you look at the TSX, you can relate to what I'm saying in terms of the differential. So the Canadian stock market is, sitting at 16,000 and change. And when you look at the total returns, you sort of look at that index and you think 40,000. I'm used to thinking about the TSX trading in that kind of range, but that includes the benefit of reinvested dividends. And so you can see we've snapped back a long way from what looked to be a lot of concern that the central banks around the world may slam the brakes on too hard. Now, so we see here, even the TSX is bouncing back. But what's, just adding a little more in market context about what's happened recently, this is fairly unusual to see such symmetry, and so we had we've given you a sense for what happened just in the fourth quarter, so this doesn't include the fact that things were pretty rocky in the third quarter as well, but you get a real sense for the symmetry between the fourth quarter of last year and then what's happened subsequent. And for those of you that are heavily invested in Canada, this is one of the first times that the TSX hasn't just been participating in the downside fully, but it's actually thankfully participated again in the upside more fully. And so it hasn't been left behind to the degree it had been historically this cycle. Now, that being said, we're essentially a decade since the depths of the credit crisis. It was, as I think everybody remembers, probably with some scar tissue, it was essentially a decade ago, in terms of the most recent end of quarter, that we really started to snap back from the credit crisis. And so when I give you longer-term market perspective, the unfortunate news is that the TSX has not performed anywhere near as well as some of its major global peers. And so it's done a fabulous job. If you didn't know that the U.S. market on a compound basis had been rallying a very high double-digit pace compared to what we're seeing, if you'd just seen 9% return for a 10-year period on the S&P TSX, I think most of us would be happy. The fact of life is that if you didn't participate in owning some global stocks, and you then saw this chart, life wouldn't feel quite as happy. We all like to participate. And so what's been happening, and we've talked about this in prior years, and the theme doesn't seem to have changed quite yet. We'll see if we're going to break out of this pattern, but it's really that the TSX has been moving towards the bottom of the pack with pretty decent gains from a total return perspective, and moving towards the bottom of the pack nonetheless. And the real distinction has been the sector exposures that we have in Canada. So you can see down towards the bottom end, energy materials, where there's a fair bit more exposure in Canada, and then up towards the top, amongst the top performing sectors globally, so on a compound return basis, you find technology and healthcare in the top 3, and the Canadian market has very little exposure. In fact, today, the healthcare sector in Canada is really made up of cannabis stocks and the former Valiant, which is now called Valuations. So it's difficult for the Canadian market to keep up when the leadership has really this cycle come out of technology and healthcare. So in terms of, have you fallen victim to this if you've owned the Tradex equity fund? The good news is no. I mean, you've participated from a Canadian standpoint, and compounding at 10.8% over the past 10 years, you'd be, if there was a third bar there, we probably should have put it in, just to give you a sense where Tradex had been. So you'd have the S&P way out front, then the global stocks, which only include about 4% Canada in there, so it's 96% things outside of Canada. We would be the next bar down as Tradex equity fund. And how has that come about? It's been because the board and the management of Tradex have done a fabulous job of having vision and working with us, and they're always, you'd be happy to know, always pressing us. We're always working back and forth in partnership to say, what else can we do to make sure that we can try to bring a really representative equity portfolio to you for how you'd all hopefully like to save for retirement. We understand that a major portion of what you spend is going to be Canadian dollars, so that's a very representative portion of the portfolio. But we also know that there's going to be a much broader opportunity set than Canada can provide. So the board has provided the opportunity over time to move into the U.S., and then we've worked alongside the board to say, let's take that global, and let's add in some emerging market equity exposure as well. And so if you said to yourself, how is it that you've ended up at 10.8% rather than participating to the tune of the TSX? And that's after fees. It's a combination of factors, but certainly global exposure is one of those, and active security selection. On the right-hand side, you're just getting a sense for the MSCI world, so that's developed markets, not emerging markets, so that's all developed markets in the world, and how well they have done versus the Canadian stock market. So that evolution has been really, really important to the growth of the portfolio over time. Pardon me. One of the things that I wanted to speak to you about as well is just one of the things that, just as the board and the management team are constantly thinking about trying to have vision, look down the road and think about what's next. How should we be building this portfolio to try to take many of the, challenging decisions off the plates of investors and give them a good experience over time. One of the other things we're thinking about is thematically, of course, what kinds of companies should we be investing in for the long haul? And one of the themes that I think you're probably all thinking about when you read the newspapers daily, and you also see the transformation in the economy, is another, disruptive sort of industrial revolution. As we think about all the things we see with electrification of vehicles and changes in the energy expectations for the future. When we think about digitization, all the conversations we now read about artificial intelligence and what that may mean to the jobs of the future, the jobs of our children and grandchildren, or our own jobs. So all of these kinds of things, do we think that there is something happening? And we do. And we think we have to be very watchful for what it means to the companies that we're investing in. So we want to be in global leaders, and we want to be in global leaders that we think have really strong competitive dynamics. And I'll come back to that in a moment, but the picture before you, I'm sure you've been able to pick up on right away, and it's just speaking about one of the last major industrial revolutions we went through, and how much it really changed the way the economy was composed. And whether we think about the number of people involved in motor vehicle manufacturing, or whether we think about urbanization and these kinds of changes. I was actually, ironically, just down in Detroit over the weekend, showing my kids around the Henry Fort, which I would encourage any of you, if you haven't been there, it's incredible. It's like a Smithsonian that Henry Ford put together. But we were riding around in Model Ts and doing all kinds of things you can only do there. But this revolution, we can all relate to. And so when we think about competitive dynamics, the kinds of things we're thinking about, we would have wanted to think about back then, is investing in industries that are growing faster than the general economy. We want to think about, obviously, the kinds of industries that are growing faster and also profitable. We want to think about companies that are engaged in those industries that are gaining market share. We want to think about the fact that they're hopefully gaining market share and profitable on a sustainable basis because they have a really strong competitive advantage. So that's what we mean by thinking about strong competitive dynamics, and hopefully companies that are either capitalizing on the disruptive technology or actually engaged in creating it. When we look at the current environment, we do see some of these same themes that would suggest we are going through some evolution, if not revolution, in the economy. And these are just a couple of similar kinds of characteristics that we can point to, just to, I think, that we can all relate to, that give us a feel. So employment in general warehousing and freight trucking, so it's up 50% over the last 10 years. And I think we can all relate to the feature that's driving that. Certainly if we just said the word Amazon, that's certainly a factor in what we're seeing. We can see what's happening on retail on the other side. I think we can all relate to that day to day. Certainly if you take a tour through the US and you see what's happening to the shopping malls in some of the areas, more of the outlying areas, and see how empty those mall parking lots are. There's certainly change afoot. And on the bottom right-hand side, you're looking at employment in mail order and obviously electronic shopping, so Amazon. That employment is doubled. So there are things afoot that in our minds, in our portfolio managers' minds, will certainly have substantial implications. So what do we do about it, or how do we try to continue to outperform? There's no question that there's a tremendous advantage that Tradex provides us in that challenge every day, which is very low fees, and provides you with very, very low fees. So that's a huge help, but we've got a hard job to do. And the team's certainly, aware of the fact, we're always aware of the fact you've got a choice. You could decide you're going to build your own global portfolio with ETFs. And should you choose to do that with a combination of whatever mix you chose, but you're basically looking at a 3,000 stock universe. If you're trying to get some exposure to emerging markets and the major global developed markets, and including Canada, it's a big universe. So if you set yourself at a base level, what's different versus an ETF, hopefully we'll decide that over time we'll be satisfied with the performance is different enough after fees to be beneficial to you. But how we're going to try to achieve that is, and this could be complementary to you, or complementary to other things you do in your portfolio or substitute for. But we're going to try to be quite careful about the stocks we're selecting in the portfolio, as you would expect. So there's 119 stocks that are in the benchmark and another 14 that are not in those benchmarks. So it's about 130 stock portfolio today in simple terms. What's it, how's it been going? There's a number of different ways to measure it. If we think about 1 year, 3 year, 5 years, one of the benchmarks that we're trying to compete with is if you just own the Canadian stock market. And so the universe of competitors we're in and the mandate we have is we can own up to 50% of your portfolio in global stocks, no more than 50%, so we always have to have 50% in Canada, and we could own 100% in Canada if we chose. So one of the challenges for us is to say, well, it's better to be utilizing those tools instead of just having the Canadian stock market. So on a 1 year basis, you could say, well, after fees, we didn't get any benefit for that, Andrew, and I would absolutely say, yes, we fought to a draw against the TSX. The key headwind for us is that we don't own any cannabis stocks, and they've really been a fabulous area of the Canadian stock market. We'll come back to that in time. Over the long haul, though, it's been quite beneficial, and when you think about the compound gain and what that means to you over time, I think Blair does a pretty good job of demonstrating that, but that extra, point, percent, couple of percent, when you compound it over a long period of time, really becomes quite beneficial. And that's, that gain you're seeing of 10.8% over time. Now, another job we have to do is we have to say, okay, there's other people who could do this job for you that are active managers, and you have any choice you want to make in terms of who you hire with a broad set of tools that you could utilize in your portfolio with Tradex. So we're doing a good job versus our peers. So within the Canadian focus equity universe that can use up to 50% foreign content, you can see that we've enjoyed a nice relative comparison, which we're going to fight hard to try to continue to maintain. So the benefit of active management or security selection isn't accruing to everybody, but it does appear to be working out well right now. And then if we give you a sense of how your ranking is, so are you scoring well in the class? So you want to be in the first quartile, so in the middle bar, that just means the top 25% of managers. And something we haven't showed you in the past, but we thought you may be interested in, that we're monitoring with the Tradex board and management team is how are we doing in terms of our actual ranking within all the funds in that universe. So as you can imagine, lots of funds don't continue to make it over time. So we're only up against 200 that have been around for 10 years. There were more back then, but they're not all still there today. And so you can see, so far so good. I think it'll be obviously difficult for us to be as consistently in the top 20 or so out of such a big universe of intelligent folks that are competing against us. But today, hopefully you're quite satisfied with how things have gone over the past 10 years. And again, our firm cannot take individual credit for that. That's been a tremendous partnership with Tradex. So let's give you a sense for the portfolio. We talked about trying to build a portfolio with global leaders that have excellent competitive dynamics, and knowing that our base is Canada. And so one of the things that's interesting when we look at the top 15 holdings in the portfolio is, and by the way, the red and the blue doesn't mean we're selling the red guys tomorrow and we're buying the blue. What I've done there is tried to put Team Canada in red and the companies from the rest of the world in blue. So that's what it's meant to illustrate to you. And you'll immediately see that you're looking at out of your top 15 holdings, 6 holdings are global, so very much reflecting that global composition. And then if you think about the Canadian holdings, I think we probably all agree that the kinds of businesses that you have in the top 15, whether it's those global companies or it's the Canadian companies, these are all actually global companies. The Canadian companies, just like RBC, our parent firm, thankfully has a head office in Canada. That's great news for all of us. But much a strong global competitor. Their investment banking business, or capital markets business as it's called, is amongst the top 10 in the world. It's a very global bank. It's considered one of the best banks in the world. And you can go through the list. I think as you travel into the US, you probably come across TD Bank in so many places. It's surprising. CN Rail, etc. As you roll through the list, you'll see other major global companies, such as United Health Group, which is really responsible for the health care for millions and millions of Americans who don't have public medicine like we do up here. So all of these companies are in, whether they be Canadian head office or otherwise, are, considered amongst the best globally at what they do. As we take this a little further and we think about, some of the disruption we were talking about, or potential opportunity in terms of the changing dynamics afoot in the economy, I thought you might want to just have me maybe touch base on some of the companies that we think have these really strong competitive dynamics and are capitalizing on the disruption, and looking at a few industries. And so transportation, you could argue it's a very old-fashioned industry. If you see like I did on the weekend, the steam trains, believe it or not, in the 1900s, it's still mind-boggling to me. They could get them up to 100 miles an hour, can you imagine? And it's not often you're necessarily driving past a CN rail train that's going 100 miles an hour. So on the one hand, you could say, geez, that doesn't seem like, if you will, or CP or CN, like a high-tech company. But then consider how much things have changed in terms of the mechanization of rail and what's really happening in terms of the optimization of rail in North America. Or consider Air Canada. We had 737 MAX 8, which was it was a very important part of their fleet. Taken, they were told by the Canadian government, you can't fly that plane overnight. And yet, if you're exposed to travel as much as many of us are, going to see clients and companies, there almost wasn't a beat skipped. So how is that happening? Well, that's a company that has a really strong digital framework, and they're really able to optimize their network of planes and schedules very, very quickly. Otherwise, 20 years ago, that would have been a complete mess for them. So within transportation and logistics, lots is happening. Nidec is a company out of Japan that makes those little motors that are helping you move your seats around, helping you move your steering wheel in and out, buzzing away in your phone, the little thing that kind of tells you somebody sent you an email or sent you a text. They're involved in all kinds of things. United Healthcare has the medical records consolidated for millions and millions of Americans, and it's only a matter of time before we stop having to walk into hospitals and deal with all kinds of paper documentation that's really ineffective and inefficient. And this is a company that will really be at the forefront of digitizing health in the United States, which is obviously the biggest market for it. Danaher, you may have read about, bought the big GE healthcare business. And so obviously lots to talk about there, but you probably read about it. On the digital transformation side, you're probably quite familiar with the Canadian company Shopify that's really been helping enable many businesses to get online. Gartner is a company that's utilized by major corporations around the world to consult on how they digitize and transform their businesses. So it essentially is almost like a little toll road for companies that are trying to figure things out in that area. You may have heard of Accenture, which has similar businesses. Financials, there's this funny acronym down there, HDFC. And HDFC is a major bank in India, and the tradition in markets outside of North America is something that harkens back to pioneer days, in a sense where cash was not put into a bank. But there's a digitization of many of these economies going on, and so HDFC is at the forefront of that kind of migration from a very traditional cash-based economy to using visas and electronics. Silicon Valley Bank is think of, and RBC does do this as well, but think of if you had a a more mid-sized RBC that was focused entirely on the companies that are in Silicon Valley, that are changing the world, and they finance them early on and build strong relationships with them, and obviously are experiencing that kind of disruptive growth with those companies. In the workflow management side, a couple of Canadian companies you're probably aware of, and one called Lightspeed that you probably, when you get to the point of sale, particularly in restaurants, you see them sort of bang away a few buttons and a receipt comes popping out. These are the kinds of companies that are evolving what was traditionally much more manual processes. And then a couple of sustainability-oriented companies, whether it's Algonquin Power with really renewable energy orientation, or American Water Works. Water is going to become so important to us. And then finally Nestea. And I'm going to skip forward and take you to Nestea just for a moment. Quite an interesting company out of Scandinavia. And what you'll see, if you can read the text here, is that this company is actually on the forefront of renewable energy. So they're actually able to recycle lots of different forms of essentially fossil fuel and oils and clean it and have it go through another cycle again as renewable diesel. So they have a tremendous position as one of the leaders, if not the leader in this area. So renewable energy in a way we didn't imagine. So these are the guys that sort of come around and pick up the used oil from if you go get your oil changed and wonder where it goes. This is the kind of company that would be picking that up or picking up various forms of biodiesel and then creating renewable energy out of it. Also in your portfolio, a company that was not there for a very long time but entered the portfolio, I think it would be about 12 months ago or so, is Microsoft. You've probably been aware that Microsoft essentially went nowhere for a very long period of time. Thankfully, we did not own it during that period of time. As you can see here, we owned Google, Intuit, Amazon, but there is a major transformation that's taken place, and Microsoft is now one of the disruptive companies that's involved in what's called the cloud. Think of it as running your business utilizing external servers instead of having to build your own. So Microsoft is in your portfolio, and this Canadian company, Cannabis, which is basically involved in helping companies do what's called supply chain management, which essentially means, when a sale is made, they understand all the pieces that have to be lit up in the production process to make sure the next item makes it back to the shelf in a speedy and efficient way. So you can think about it from that perspective, but a Canadian company that's got a pretty unbelievable list of global companies that's helping that particular area. So those are some of the kinds of things that we own in the portfolio that we think reflect those kinds of themes. And then finally, what I mentioned earlier on, that we'd come back to speak about cannabis. We don't own cannabis in the portfolio. It's not a moral standing. It's not that we'll never own it. We simply have struggled with the fundamentals. So we've had on one occasion a small allocation when there was a sell-off that warranted an opportunity for us, but it really hasn't been something that's warranted for us having substantial holdings in the portfolio, and it's a key headwind for us that we have to recognize. These stocks, there's no question, have had tremendous gains. Many investors, hopefully some in this room, have managed to have some magical insight and benefit from the tremendous returns they've had. But we really have to ask ourselves always about the fundamentals. And there, as outlined here, there's just too many questions for us to have a high degree of conviction around owning these companies today. It's not to say that there won't be a legitimate industry. It's not to say that they won't participate in your portfolio on the Canadian side or perhaps the US side at some point. It's just to say today that we don't have a strong enough fundamental rationale to know we can own them. But they are theoretically disruptors, and we just haven't got them yet. So with that, I know there's usually some interest in the outlook. There's no question we don't have a crystal ball, so all we can try and give you is some touch points to perhaps consider. And one of the touch points would be, how have things gone so far? Well, judging by the fact, I'm guessing this isn't the record attendance we've seen. Usually record attendance is when markets are at their worst. So after the first few months of this year, it's as good as the cookies were. There's probably not been the record attendance you'd normally see if markets were in rougher shape. That, there is a bit of a warning sign in the fact that this is one of the best starts we've ever seen. If we look back at some of those other years, seeing 1930 just above us, that it isn't suggesting that we should expect this pace to continue, and we wouldn't. That said, we think there are a lot of fundamentals that are still reasonably sound. Earnings are still growing globally, and that is interesting, the second part. So you've had synchronized global growth, which is pretty good. And of course, the United States, having some leadership in that, is good. We're still seeing a lot of stimulus being applied. It's shocking to be 10 years into the cycle and we're still seeing stimulus. So we've seen the Federal Reserve in the US, as you've heard about already this evening, sort of backing off and taking his foot off the brakes. But China's actually going far beyond that. They're stepping on the gas. Just as Donald Trump has actually made it a little tougher on them with the tariffs, they decided to offset that by stepping on the gas and showing some success in maintaining 6.5% growth as a result. So when we think about those things, there's some reasonable fundamentals there. And then if you say, okay, well, what about the valuations? Well, right now we can say from our models, which are on the left-hand side, that the global stock market is massively overvalued. We could say that lots of asset classes, including global stocks, are fairly valued to fully valued, and I'd say the global stocks we think of as fairly valued, but with this appreciable earnings growth. There's other asset classes that appear to be much more fully valued. And on the right-hand side, we could throw up other metrics, just sort of break them down for you. You don't have to look at what each individual one is, but the bars that are above the middle point would suggest that some metrics would suggest the market's overvalued. One of them you probably hear about in the press many, many times is the Shiller. Shiller's got a PE that's sometimes called a Shiller PE or the Cape. And the one thing to be aware of is most of this cycle it suggests that the stock market is overvalued. So if you used that metric, you probably would have participated in the first couple of years of this stock market rally. It's not to say that the Yale and Nobel laureate Robert Shiller doesn't know what he's talking about, but this metric, it's not proven itself to be as valid as I think many people thought. So it's fair enough to say that you could say the market's modestly expensive to cheap on a variety of metrics. The one thing that is, I think, hard to argue is that, whether we speak to our fixed income teams or equity managers, is between, stocks and bonds, we'd still prefer bonds. We still think stocks offer a better relative valuation and the potential for growth in the coupon, so to speak. So what do you do with this? Well, you could put all your cash in Bitcoin or stuff it in your house and walk away from the market. Our view would be the same as we've given you before, spending time with the team here, building a strategic view of what you're trying to achieve, revisiting regularly, and really betting on the long haul returns from staying invested as opposed to trying to time the market. Right now, as we're late in the cycle on number of years, it's yet to be determined if we're late in cycle on the earnings growth. But one thing we have seen in prior cycles that speaks to the challenge of trying to time markets is the latter part of the cycle is often a good period for gains. And so with that, I'd certainly say thank you again for your faith in us, and we appreciate having some time to speak to you this evening. Happy to take any questions.